Assalamualaikum and hello everyone. Today we'll be presenting an overview of Maxis and Digi, which is two major players in the Malaysian telecommunication industry. Let's begin. Let's start with Maxis. Maxis has been a leading telecommunications provider for over 25 years. They offer a variety of services including mobile, fixed line, and international telecommunications. Maxis has been innovative with their products and services, reaching over 93% of the Malaysian population. They have also established a strong ecosystem of partnerships with notable companies like Astro, Yahoo, and Apple. Now, moving on to Digi. Digi is another key player in Malaysia, known for its robust mobile network and digital solutions. Their focus on innovative technology and a wide network system ensure a top-notch user experience. Digi has also established itself as one of the leaders in the prepaid segment, catering to a broad audience. Together, Maxis and Digi have made significant contribution to the telecommunications landscape in Malaysia, continuously innovating to meet the needs of consumers. As a brief overview of Maxis and Digi, they have set benchmarks for innovation and connectivity in Malaysia, making them integral to the nation's digital evolution. Now, we look forward to the other question.
Let's look at the financial ratio. For the current ratio, Maxis peaked at 0.63 in 2020 but dropped to 0.48 in 2021, indicating a weak liquidity. Digi's strongest was 0.67 in 2019, falling to 0.49 by 2021. Asset-to-asset ratio mirrored the current ratio. Maxis achieved highest at 0.63 in 2020. Digi's highest was 0.64 in 2019, indicating a reduced ability to cover liabilities without inventory. Days in receivables improved for Maxis to 39 days in 2020 but worsened to 72 days in 2021. Digi's best performance was 58 days in 2020, slightly increased to 61 days in 2021, indicating a minor inefficiency. Maxis account receivable turnover peaked at 9 times in 2020, reflecting highly efficient local collection, but fell to 5 times in 2021. Digi's best was 6 times in both 2020 and 2021. Days in inventory for Maxis remained stable at 1 day across all years, indicating high efficient inventory management. Digi's holding period increased from 17 days in 2019 to 28 days in 2021, showing a gradual decline in efficiency. Maxis inventory turnover declined from 679 times in 2019 to 358 times in 2021, reflecting a reduced inventory efficiency. Digi's turnover dropped from 21 times in 2019 to 13 times in 2021. Maxis total asset turnover decreased from 0.43 in 2019 to 0.41 in 2021. Digi's improved to 0.81 in 2021, show more efficient utilization. Maxis fixed asset turnover decreased from 0.50 in 2019 to 0.47 by 2021. Digi's best was 1 in 2019, was slightly recovery to 0.99 by. Operating return on asset for Maxis declined from 9% in 2019 to 8% in 2021. Digits also dropped from 23% in 2019 to 90% in 2021, reflecting weak profitability. Maxis operating profit margin fell from 22% in 2019 to 90% in 2021. Digits declined from 13% in 2019 to 24% in 2021, reducing operational efficiency. Return on equity for Maxis dropped from 21.5% in 2019 to 90% in 2021. Digits fell from 2.87% to 2.39%, indicating a weaker return from shareholders. Maxis debt ratio increased from 67% in 2019 to 70% in 2021, reflecting a growing reliance on debt. Digits ratio remained high at 92 until 93%, indicating a significant financial leverage. Time interest earned for Maxis declined slightly from 4 times in 2019 to 3.84 times in 2021. DGs improved from 14 times in 2019 to 60 times in 2021, showing better coverage of interest obligations. Maxis price over earnings ratio increased from 8.92 in 2019 to 10.78 in 2021, indicating a higher market evaluation. DG remains stable at 0.02 across 2020 and 2021, reflecting lower valuation. Maxis improved its price over book ratio from 0.10 in 2020 to 0.14 in 2021. DGs recovered to 1.14 in 2021 after dropping to 0.93 in 2020, indicating a stronger market perception. Economic value added for Maxis declined from 857 million in 2019 to 673 million in 2021. DGs dropped from 1,059 million in 2019 to 706 million in 2021.
Is your organization based on the table? This ratio helps us understand how well these companies can meet their short-term obligation using their asset. Let's start with the current ratio, which compares current asset to current liabilities. This ratio indicates a company's ability to pay off short-term debt. In 2019, Maxis had DG had a slightly better in liquidity position. However, both ratio were below 1. Neither of the company could fully cover its short-term liabilities. In 2020, Maxis was slightly better than DG, indicating Maxis was a better position. But again, both were still below 1, showing that continued liquidity concerns. By 2021, both companies saw a decline in their ratio. That means both had worsening liquidity position and unable to meet short-term obligation effectively. Next, we have asset test ratio, which is more measure of liquidity. This means inventory from asset may not be quickly converted to cash. In 2019, DG had a stronger asset test ratio compared to Maxis, showing that DG better ability to make short-term debts with liquid asset. In 2020, Maxis improved to surpassing DG, meaning Maxis was in a slightly better position regarding liquidity assets. However, both companies still face liquidity concern. By 2021, Maxis and DG both still below 1, signaling critical issue in meeting short-term obligation without relying on inventory. On conclusion, both Maxis and DG have faced liquidity challenge from 2019 to 2021, with their ratio consistently below ideal of 1. Although DG had a position in 2019 and Maxis in 2020, both companies need to improve their liquidity management either by increasing current asset or improving cash flow management to avoid difficulty in paying off short-term liabilities.
Today, I will present about how the manager generating an adequate operating profit on the organization asset. First thing first, I'm very sure that every company, those who are established, must want to make a profit, right? Therefore, company need to ensure that their business operating system runs smoothly and know how to grow their business. So, based on data that we can see, for return on asset, in every year, DG get a more percent than Maxis. This indicates that DG is more efficient in utilizing its asset to generate profit compared to Maxis. Next, for operating profit margin, we can see that DG also get more higher percent in every years. That means DG is better at managing costs and increasing in operating profit. So, to conclude, we can see that DG outperformed Maxis in both return on asset and operating profit margin.
Let's move on to the organizations that can finance their assets through debt and equity financing. The debt to equity ratio can help to measure the amount of debt for both companies, Maxis and DG. Based on the table, DG show a range between 492% to 900%, which is the financial is a bit concerning. The company is facing a lot of debts that will impact its profit and abilities. Also, the financial risk is high and has a challenging time recovering its liabilities. Meanwhile, Maxis range is between 31% to 107%, which means the financial standing is excellent. This shows that Maxis has low liabilities compared to its equity. The company is less risky and less reliant on borrowing to finance its operation.
Starting with Maxis, we can see a steady decline in ROE over the years. In 2019, Maxis recorded a strong ROE of 21.5%, but it dropped to 90.6% in 2020 and further decreased to 90% in 2021. This decline might indicate challenges in maintaining profitability or efficient equity utilization. Now, looking at DG, there's striking an anomaly in 2019 with an ROE of 270%. This unusually high figure could be due to extraordinary income or specific financial strategy that year. However, in 2020, DG's ROE normalized significantly to 21.5%, aligning closely with Macy's. In 2021, it declined further to 80.4%. In summary, while both companies saw decline trends, DG's drastic change in 2019 stand out. The year-over-year trend suggests potential areas for improvement in maximizing shareholder value.
In conclusion, we have chosen a suitable company to invest in Maxis. Based on the calculation and table above, Maxis shows that the year-over-year growth, which is modest growth of 2.02% in 2019, then declined to negative 3.73% in 2020 and recovered to 2.04% in 2021. Maxis ratio shows a lower percentage than DG's. Not just that, Maxis has a good growth potential because its financial structure is more stable. Maxis is suitable for investors who are looking for stability in the long term.